Peter Lynch believed that the greatest advantage in investing isn't expertise, it's everyday experience. One Up on Wall Street is Peter Lynch's practical guide for individual investors, based on his legendary performance managing Fidelity's Magellan Fund, where he achieved nearly 29% annual returns over 13 years. In this book, Lynch explains why ordinary investors can outperform professionals if they use their natural advantages wisely. His core belief is clear. Individual investors often spot winning companies long before Wall Street does. Find investment ideas in everyday life. Lynch encourages investors to look around at stores, products, workplaces, and daily habits. Popular brands, fast-growing products, and emerging trends often appear in real life before analysts notice them. As he famously said, the average person is exposed to interesting companies years before Wall Street. Humberstashop classify companies into 6 categories. Lynch divides stocks into 6 types: slow growers, stalwarts, fast growers, cyclicals, turnarounds, asset plays. Each category requires a different strategy and expectation. Treating all stocks the same is a guaranteed path to disappointment. Understand the story. First, numbers second. Before spreadsheets, Lynch asks one essential question: why should this company succeed? He favors simple, understandable businesses with clear competitive advantages. Financial metrics matter, but only after the story makes sense. Patience beats timing. Short-term price movements are noise. Great companies reward investors who hold them long enough. Lynch warns, selling winners too early is one of the biggest mistakes investors make. Ignore Wall Street noise. Market predictions, headlines, and expert opinions often distract more than they help. Lynch insists investors should only own stocks they fully understand. If you can't explain why you own a stock, you shouldn't own it. The true lesson of this book goes beyond investing techniques. It's about discipline, independent thinking, and emotional control. As Lynch puts it, investing isn't about IQ, it's about character. Next, let's explore how Lynch's philosophy plays out in real-world investment examples and why it remains relevant today.
What if one of the greatest investors of all time told you that you, yes, you, have a secret edge over Wall Street? And what if he gave you a simple 5-minute formula to find amazing bargain stocks? Well, that's exactly what we're doing today. We are unlocking the secret of the legendary Peter Lynch. So why should we even listen to this guy? Well, it all comes down to this number, 29.2%. That was Peter Lynch's average annual return when he was managing the Fidelity Magellan Fund from 1977 to 1990. I mean, to put it simply, the man was a master at finding winning stocks. His results are the stuff of legend. But how did he do it? And this quote, this right here, is the key to his entire philosophy. He believed investing wasn't about some secret, complex algorithm. Nope. It was about diligent research, literally just turning over more rocks than the next person. He argued that the best clues are hiding in plain sight, right in front of us. Okay, so here's our game plan for breaking down his method. We'll start with the legend himself. Then we'll talk about your unique amateur's edge. After that, we'll get into his fair value formula. Then we'll actually put it to the test with a real stock. And finally, and this is super important, we'll cover some words of warning. So let's start with his game-changing book, One Up on Wall Street. You have to remember, at the time, investing felt like this exclusive club just for Wall Street insiders. But Lynch came along and shared this totally revolutionary idea that everyday people could actually beat the pros at their own game. His central message was just so shockingly simple. He said that your experience as a consumer or as an employee or even just as a hobbyist gives you this incredibly powerful advantage. You know, you're the one who sees which stores are always packed or which new gadget your friends can't stop talking about. That is real-world information that Wall Street might not see for months. So how does this whole boots-on-the-ground knowledge actually give you an edge? Well, Lynch called it the amateur's edge, and it's all about turning your outsider status into a massive strength. And this really shows you the difference. See, Wall Street pros are often stuck. They're trapped in groupthink, they're bogged down by regulations, and they're usually forced to stick with huge, well-known stocks. But you're free. You can take a chance on a small, up-and-coming company. You can be patient. You only have to answer to yourself. And that is your edge. So you find a company you like based on your own experience. How do you turn that feeling into an actual investment decision? Well, that's where this practical tool comes in. Lynch developed a super simple formula to quickly check if a stock's price actually makes sense. And here it is. Don't let the letters scare you. It's actually really straightforward. The formula takes a company's expected earnings growth, adds in the dividend yield, that's just the cash they pay out to you as a shareholder, and then divides all of that by the PE ratio. The PE ratio is just a measure of how much investors are willing to pay for the company's earnings. The final number gives you a quick snapshot of whether the stock is cheap or expensive. So let's break it down into 3 simple steps. First, you have to estimate the company's future earnings growth. Now, this is the trickiest part, and we'll come back to it. Second, you find the dividend yield. And third, you find the price to earnings, or PE ratio. Both of those are pretty easy to find online. Now, this is the crucial part. What do you do with the number you get? Lynch laid it out for us. If the ratio is below 1.0, that's not great. It suggests the stock might be overvalued. Around 1.5 is okay, fairly valued. But what you're really hunting for is a 2.0 or better. That's the signal for a potentially undervalued company, a rock that's definitely worth looking under. All right, enough theory. Let's put this thing to the test. We're going to run the numbers on a real company, the energy giant Kinder Morgan, ticker symbol KMI. And we'll be using data from Yahoo Finance as of May 2024. First up, we need to estimate that future growth. Now, as you can see from this chart of Kinder Morgan's earnings per share, it's been a bit of a roller coaster. So while some analysts are predicting around 5% growth, Lynch always preached caution. So we're going to be conservative and use a 3.0% growth rate in our calculation. Okay, that was the hardest part. The next 2 ingredients are easy. At a stock price of $19.70, Kinder Morgan's dividend yield is a pretty healthy 5.71%, and its PE ratio is 18.58. So now we have everything we need to plug into the formula. So here we go. We just plug it all in. We add our conservative 3.0% growth rate to that 5.71% dividend yield, and then we divide that whole thing by the PE ratio of 18.58. And the result is 0.47. So, what does this number actually tell us about Kinder Morgan's stock? Well, according to Lynch's framework, a ratio of 0.47 is way below 1.0. This suggests the stock is probably overvalued. It means the price investors are paying isn't really justified by its dividend and our conservative guess for its future growth. It's basically a red flag telling us to be cautious here. But and this is so important. No formula is a crystal ball. Lynch himself would be the first person to tell you that. So let's talk about the limitations here. First off, the whole thing hinges on your estimate for future growth, which, let's be honest, is a guess. It also assumes growth happens in a nice straight line, which it almost never does in the real world. It's a simplistic approach that doesn't look at things like debt, and it doesn't work at all for companies that don't have earnings or don't pay a dividend. And this is really the most important takeaway of all. This formula isn't some magic button that spits out answers. It's a powerful filter. It's the first step in turning over those rocks, helping you find companies that might be worth a much closer look. So that kind of brings us full circle, doesn't it? Peter Lynch gave us a fantastic tool, but his real gift was a philosophy. Trust what you see in the world, do your homework, and use your unique perspective. Maybe the ultimate secret to investing isn't a complex formula at all, but just the common sense you already use every single day.
When you think about the absolute legends of investing, the name Peter Lynch always comes up.
Oh, absolutely.
He wasn't just, successful. He completely changed the game, taking the Fidelity Magellan Fund from this relatively small thing.
And turning it into the biggest mutual fund on the planet during his time there.
It's just an incredible story.
The track record is almost hard to believe, honestly. And for you, the listener, just listen to these numbers. Between May of '77 and May of 1990, Lynch pulled off an average annual return of 29.2%.
29% annually.
Yeah. He didn't just beat the market. He demolished it. He grew the fund's assets from what? $18 million to over $14 billion.
Wow.
So our mission in this deep dive is to really unpack the philosophy behind that. How did he build a system that actually empowered the everyday person? And we're going to dissect this really powerful but surprisingly simple valuation tool he used.
And I think that's the key takeaway we want to get to right up front. Lynch's core belief was that you, the person at home, managing your own money, you have a genuine distinct advantage over some highly paid professional on Wall Street.
A huge advantage, and he spent his career showing people how to use it.
Okay, so if we're ready to use the superpower, where do we start? The simplest Lynch rule is buy what you know.
Right.
Which, I have to say, it sounds almost a little too easy, Why would observing my local coffee shop lead to these massive multi-billion-dollar returns?
Because it plugs you into what he called local knowledge. Or maybe more importantly, it lets you see trends way before the financial world does.
Okay.
He actually had a term for it, street lag.
Street lag, I like that.
Yeah. He basically argued that these big shifts in, consumer habits or technology, they often take months, sometimes even years, to actually filter up through the analysts and appear in the formal report.
That is such a fascinating concept because it implies the whole market, the official market, is just inherently slow.
It is. We, the consumers, are basically the beta testers for the entire economy.
That makes so much sense.
Absolutely. And just think about where his best ideas came from. They almost never came from some, secret high-level industry report.
Right.
He invested in Dunkin' Donuts after he'd just high. He noticed how busy his local Boston shops were all the time, and he realized he really loved the coffee.
It was that simple.
Or the classic example, Legs Hanes Hosiery. They started selling them in grocery stores, which was this huge distribution breakthrough that his wife Carolyn spotted while she was just doing the weekly shopping.
I remember reading about Taco Bell, too. That was another huge win for him. And it first got on his radar just because his family loved eating there.
Exactly. It brings it all back to just common sense. So if the individual investor has this amazing edge, why don't the professionals use it?
Well, that's where the institutional handcuffs come in, right?
Yeah.
This is why your freedom is your superpower.
Yeah, that's a good way to put it.
Wall Street fund managers are stuck. They have these rigid rules. They need everyone to agree on an idea. And maybe most importantly, they have this deep, deep fear of failure.
The whole system incentivizes groupthink. It pushes them toward mediocrity.
How so?
Well, think about it. If a professional invests in some tiny, unconventional stock, a potential 10-bagger, and it goes to zero.
They could lose their job.
Exactly. But if they invest in some big blue chip stock that everyone recommends and that stock collapses, they just shrug and say, well, everyone else owned it too.
There's safety in the herd.
Yeah.
And that fear makes them ignore the smaller, weirder companies.
The very places where an individual can find those legendary 10-bagger stocks that go up 10 times their original value, you have the agility to go into those overlooked corners of the market.
And Lynch practiced what he preached, right? I mean, even in how he ran Magellan.
Totally. When he took over the fund, it held, maybe 60 stocks? By the time he left, it held an almost unheard of 1,400 stocks.
1,400.
He wasn't worried about consensus. He just bought bargains wherever he could find them.
Okay, so that leads us right into the next critical step in his playbook. It's not enough to find a company you like. You have to know exactly what kind of company it is.
Yes. This is foundational.
He insisted you have to classify it to set the right expectations and, avoid making a huge mistake, like confusing a slow, stable company with a high-growth rocket ship.
If you don't know which category your stock is in, you have no way to even start analyzing its valuation. He split the whole universe into 6 categories.
6. What are they?
Slow growers, stalwarts, cyclicals, fast growers, asset plays, and turnarounds.
Let's maybe focus on a couple of the big ones, like stalwarts and fast growers. What's a stalwart?
Stalwarts are your big, established giants. Think Coca-Cola, Procter & Gamble.
The household names.
Exactly. They're stable. They're aiming for, moderate annual earnings growth, maybe 10 to 12%. Lynch would hold some of these just to provide some stability, some ballast for the portfolio when the market gets rocky.
Because people are still going to buy toothpaste and soda.
Right. And with the stalwart, the main question you're always asking is about the price. Specifically, the PE ratio.
Okay, wait, let's pause right there because that's a term we use a lot.
Mm-hmm.
How do we explain the PE ratio in a really simple way?
Sure. The PE, or price-to-earnings ratio, is just how many dollars you, as an investor, are paying for one single dollar of that company's yearly earnings. So if a stock is $20 a share and it earned $1 last year, its PE is 20.
Got it.
And when you buy a stalwart, you need a low PE because its growth is steady, not explosive. If the PE is too high, you're just paying too much for that limited future growth.
Okay, makes sense. Now, how does that compare to the fast growers? These are the potential home runs.
Right.
Fast growers are these small, aggressive new companies that are aiming for something like 20 to 25% annual growth.
That's a lot.
It is. Lynch loved these, especially when he could find one in an otherwise slow-growing industry. But he was also really cautious about any company promising growth faster than 25%.
Why is that?
Because that kind of hypergrowth is like a siren song. It just attracts fierce, destabilizing competition that can wreck the business.
And he had a kind of checklist for these fast growers to make sure they were the real deal.
He did. You had to make sure the product was actually core to the business, that the concept was replicable, so they could repeat their success in other cities or towns, and crucially, that they still had a lot of room to expand. If they're already everywhere, well, the growth story is pretty much over.
And one of the biggest warnings he gave, no matter the category, was to avoid something he called diversifications.
Yeah. Diversification. That was his term for when a good company starts buying a bunch of unrelated businesses. It dilutes their focus, it drains their resources, and it almost always ends up hurting their future earnings. They stop being great at one thing and become mediocre at a lot of things.
Right. They lose what made them special in the first place.
Exactly. Which brings us to valuation. All this classification is designed to lead you to one question. What's a fair price to pay? And this is where Lynch gave us a really fast, objective way to screen stocks. It's a modification of the PEG ratio, sometimes called the PEGI ratio now. It's a quick way to see if a stock is fairly valued given its growth.
This is such a critical, actionable piece of his advice. You need some way to combine the price you're paying, the PE ratio, with the return you expect to get. So what's the formula?
It's actually really straightforward. You take the future earnings per share growth rate, you add the dividend yield to that.
Okay, so growth plus dividend.
Right, and then you divide that entire sum by the PE ratio.
So if I'm understanding this, the top part of the fraction, the growth rate plus the dividend, that's basically your total expected return from the stock.
That's a perfect way to think about it.
And the bottom part, the denominator, is the price you're paying for that return, measured by the PE.
That's it exactly. And the number you get from that calculation is your value score. And Lynch's interpretation is the key here. A ratio of 1.0 means the PE perfectly matches the expected return. That's, fair value.
But fair isn't good enough for him.
No. Lynch taught that you should demand more. He looked for a ratio of 2.0 or higher. That signals a really strong, undervalued opportunity, and anything less than 1.0 suggests the stock is probably overvalued.
Okay, let's use the real-world example from our source material to really lock this in.
Right.
The calculation for Kinder Morgan, or KMI.
Right. So if we just plug in the numbers, KMI has an expected EPS growth of about 3.0%.
Okay.
And it has a dividend yield of 5.71%. So you add those together.
So they give you a total expected return of 8.71%.
Exactly. Now, the company trades at a PE ratio of 18.58. So you divide 8.71 by 18.58.
And that gives you a fair value ratio of 0.47.
0.47.
Which is way below the 1.0 for fair value and nowhere near Lynch's target of 2.0. That feels very overvalued.
It is. The math tells the story. You're paying 18 and a half years of earnings for this stock, but you're only expecting about an 8 or 9% total return. By Lynch's standards, that's just a bad deal.
It's a really simple, powerful screen. But I assume it has its limits.
Oh, for sure. We have to acknowledge them. This whole method relies very heavily on correctly guessing future EPS growth.
Which is an art, not a science.
It's always subject to error, to management spin, and it also kind of assumes that growth happens in a straight line year after year, which, the real world just doesn't work that way.
And it ignores some pretty big structural things, too.
Exactly. It doesn't look at debt levels or a company's competitive advantage, their moat. It's not a full-blown analysis like a discounted cash flow model. This is a tool to tell you where to start digging, not the final word on whether to buy something.
Speaking of digging, Lynch always said a company's annual report is the single best resource you have. Way better than stock tips or rumors.
Yeah.
So when he was reading those reports, what were the absolute key numbers he focused on?
He had a golden rule that just cuts through all the noise. He said, if you can follow only one bit of data, follow the earnings.
The bottom line.
The bottom line. He was convinced that sooner or later, a stock price always catches up to its underlying earnings and assets. That's the gravity of the situation.
So beyond just profits, what about the company's stability? The balance sheet had to be a huge focus.
It was everything. He was obsessed with the debt factor, specifically the debt-to-equity ratio. Lots of equity compared to debt means financial strength. He also pointed out that a big net cash position, so cash minus long-term debt, can actually act as a kind of floor for the stock
On
price.
safety net.
A huge one. He always noted that a company with zero debt, like Apple was back in 1997, simply cannot go bankrupt. That gives you incredible downside protection.
That is a massive advantage. Is there another number that the everyday investor should watch for that might signal trouble ahead?
Yes, inventories. Especially for cyclical businesses like retailers or manufacturers. If you see that inventory is consistently growing faster than sales quarter after quarter.
That's a huge red flag.
Huge. It means they're making stuff that people aren't buying. It signals real trouble, or maybe a big cyclical downturn is coming, which goes right back to why you have to classify your stocks correctly in the first place.
And this is where it gets really interesting for me because Lynch was just as focused on the investor's own mind. He had this list. The 12 silliest and most dangerous things people say,
Yes.
acknowledging that success in investing is as much about your own emotional discipline as it is about the numbers.
And we all fall for these traps. I mean, if you've ever said to yourself, the stock can't go any lower right before it gets cut in half again, you know exactly what he meant.
Oh yeah, been there.
That phrase has probably destroyed more portfolios than anything else.
Or what about the opposite mistake? Thinking that just because a stock's price went up, your original idea must have been right.
The stock's gone up, so I must be right.
Yeah.
It completely ignores the fundamentals. Maybe you just got lucky. Lynch was adamant that being super intelligent, having a high IQ, or a fancy MBA is absolutely not required for success.
What is required then?
It's the emotional qualities, patience, confidence in your research, common sense, and the independence to act when everyone else is panicking.
So his advice really boils down to this. Treat your portfolio like a collection of small businesses you actually own, not just a list of ticker symbols you're betting on.
That is precisely the mental shift he was demanding.
Mhm.
You need that rigorous analysis, but you have to combine it with the emotional discipline to see it through.
To ignore the noise and focus on the long-term story.
Exactly. And that's Peter Lynch's enduring legacy. It's so powerful. True success comes from having that long-term view, doing the homework, classifying your stocks correctly, and just ignoring all the chatter about timing the market.
And his advice is timeless because it's not about charts or algorithms. It's about the business.
It's always about the business. The fundamentals will eventually determine the price.
So what does all this mean for you, the listener? I think Lynch proved that your own daily life, your job, where you shop, what your kids are into, that's a powerful, untapped well of investment ideas.
Often months before Wall Street even has a clue.
And the only person you're really competing against is the one you see in the mirror. You just have to beat your own emotional impulses.
So here's a final thought to leave you with. If Peter Lynch, one of the greatest of all time, truly believed that the individual investor has this built-in edge over Wall Street, what product or service that you use every single day might be a 10-bagger that the professionals just haven't bothered to cover yet? Something to think about as you just look at the world around you.